Welcome to the latest edition of Fundamentals. This time around, I'm going to look at a so-called passive fund, namely Vanguard FTSE Japan ETF. Now, this is an exchange-traded fund, or ETF. It's designed to track the performance of the underlying assets and then deliver that performance minus its running costs. In this case, the ETF is tracking the FTSE Japan index, which covers large and mid-cap Japanese stocks that are themselves members of the FTSE All-World benchmark index. The ETF uses physical replication to provide performance, which means it owns the actual underlying stocks. As I sit here, there are 493 companies in the portfolio, and the top 10 holdings represent just under 18% of the assets under management. So any advisor or client buying this will get diversified exposure to the Japanese stock market. The largest individual stock positions are car maker Toyota, Mitsubishi UFJ Financial, technology to telecoms group SoftBank, Sony, and finally Sumitomo Mitsui Financial. This first chart shows the £850 million portfolio's weightings by sector. Industrials, consumer discretionary and technology are the three biggest exposures at 19, 18 and 14% of the assets respectively. By contrast, energy, utilities and real estate have a combined presence of barely 7%. Dividends are paid quarterly and the historic yield is around 1.6% based on the 36 pence of dividends paid out over the past 12 months and a price for the ETF of just north of £22. The ongoing charge figure for the ETF is just 0.19%, a figure beaten by just 2 of 37 rivals, so Vanguard FTSE Japan ETF looks pretty cost competitive. The ETF's just over 4 years old and it comes with a 4-star ranking from Morningstar for those advisors and clients who put value in such things. As a final point, the ETF comes with both sterling and dollar priced versions. We're talking about the one that's denominated in pounds on this occasion. So those are the mechanics. The next question is, why would an advisor or client consider this ETF for portfolio inclusion today? And I think there are 3 possible factors to consider. The first is that Japanese stocks are doing pretty well. The Nikkei 225 index is back flirting with the 20,000 market last reached in summer 2015, while the broader Topix benchmark is trading near 1600, again pretty much a 2-year high as we can see here. Those figures mean that the Vanguard FTSE Japan ETF itself has done well since inception too, as we can see in this next graphic. The second possible reason to consider is that Japan has just recorded its 6th straight quarter of GDP growth, the best run in a decade. This implies that Prime Minister Shinzo Abe's programme of economic, political and social reforms, known loosely as Abenomics, is working, ironically at a time when Mr Abe's popularity with the voters is sagging to its lowest level since he took power in late 2012. The third factor to consider is that Japanese companies, encouraged by Abenomics, are becoming more shareholder aware, increasing dividends, launching share buybacks and focusing on bolstering profits and return on equity. With 493 holdings and a low ongoing charge figure, Vanguard FTSE Japan ETF provides cost-effective and nicely diversified exposure to those 3 themes. But this is not to say the product is suitable for everyone, because there are 3 risks and possible downsides that must be taken into account. First, the 1.6% yield may not be enough for those advisors and clients who are seeking income. Second, the Bank of Japan is running a huge quantitative easing programme, running at 80 trillion yen a year, or about £560 billion annually. Remember, the UK's total QE scheme over the last decades comes to only £445 billion. The Bank of Japan's not just buying bonds either, it's buying ETFs like this one. So skeptics will want to know why you should buy a market where the central bank was the single largest buyer of stocks in 2016, and where the central bank owns 3/4 of the total assets in Japanese ETFs. At least according to research from Societe Generale. That begs the question, what happens when the Bank of Japan stops QE and stops buying, or even tries to unwind it and starts selling? Third, in terms of economics, Japan is where no one wants to go. It's run QE and low or zero interest rate policies to match those of the US, UK and Europe on and off for the last 20 years or so, battling deflation, weak demographics and government debts that come to around 240% of GDP, the highest figure in the world as we can see here. Bears of Japan will therefore argue the country remains a debt-riddled basket case, destined to suffer poor growth unless the social reforms go even further and perhaps the taboo subject of immigration is tackled to help compensate for the low birth rate. There's also the additional complication of the regional tension stoked by North Korea's 6th nuclear test and its test flight of a missile over Japanese territory. So when you do your research, it's therefore important to make sure that Vanguard FTSE Japan ETF fits with the advisors and clients' particular overall investment strategy, target returns, time horizon, and appetite for risk. Thank you for watching, and I look forward to seeing you next time.